Silver price, which has been unwinding. Chris just mentioned it, down about 15% in a couple of days. If there was already a bearish mood, did you think that that services sector read added to that?
I think so. And just keep in mind, like even what we said last week, silver has become a good trade, not necessarily a good investment. It seems right now that whole short dollar, long risky asset trade is getting really stretched right now. So with that in mind, silver is going to be very volatile, and the fact that we broke 18% in the last 2 weeks is no big surprise to me whatsoever. And given the fear of the hawkishness coming out of China with all the industrial metals, I could see silver continuing to go down.
So did you feel, I mean, because we here in Australia yesterday watched the Shanghai Composite Index down 2%. Larry, did you feel that that did have a ripple effect across markets overnight?
I do, and actually I was tuning in the Sky last night when you guys first came on, and I was perplexed why China was down almost 2%, you were down 1%, and it seemed like so much hawkish tone came out of China in one night, where the People Bank of China annual report came out saying that maintaining inflation control is our #1 priority, and that their required reserve ratio has no ceiling. Couple that with the fact that the front page of the Chinese Securities Journal said that we probably will be raising rates in May. I mean, it just caused a lot of shock in the market and made people realize that, hey, this trade is getting really stretched right now, and maybe it's time to take some profits.
And Alan, if we put it back onto the US economy, where we saw this weak data, I know Larry's noted an article in the New York Times that suggested that maybe we're seeing a risk that the US economy is stalling out again. But then again, for markets, isn't that in a kind of a perverse way a good thing? Because as long as the US economy looks weak, someone has to provide stimulus, and then traders love that.
Good point. I do agree with that article. I think we are getting a little tired here. Again, the economy. I think it's going to be interesting to see what the Feds do with this QE2 when that expires. Last time QE1 expired, the market really took a nosedive. It fell about 1,600 points in between QE1 and QE2. So now we think the market probably follows suit. We don't think this market can sustain itself on its own. So yeah, we will be watching that very closely.
Hi Alan, Chris Stott here from the studio in Sydney. You mentioned QE1 and QE2 and the reaction of the market that we've seen over the last 6 or 12 months to those policies being implemented. To what extent do you think there's a QE3 around the corner?
Oh, I think there's definitely QE3. I mean, we saw the unemployment numbers today, still very weak. I mean, we're at 8.8%. That's still really up there. You see foreclosures, you see homes. The only shining spot in this whole so-called recovery is the equity market. You take the equities out of this, and the economy even looks twice as bad, especially in an election year coming up. So I think for sure there'll be some kind of QE3, whether they call it QE3 or whether it just be repurchasing other bonds. But there'll be something to keep this market going, something to where they're fueling this market, and it's not going to sustain itself on its own. It's just too weak right now, and we're seeing it like every day. You're seeing this fluctuation, but basically the market is getting a little tired up here.
Look, and do you think that we'll see a similar reaction to QE3 if and when it gets announced in terms of the equity market rising off the back of that news?
Yes, without a doubt. Because remember, what QE2, basically what they're doing is the Feds are pumping about $100 million a month into the market. They're buying treasuries, and they're buying from large institutions, which in turn are going into risk market. They're coming into equities, they're coming into commodities, and that's what's fueling this whole rally. We don't see the average investor in this market anymore. We saw more of the institutions that are just trading this market, and it's all a result of QE2. That's what the Feds wanted. That's what they're getting here. But it's not sustainable for the average market, so it's got to be fed by the QE2s, by the QE1s, and that's what we're seeing. And without that, we think this market probably does tank a little more.
And Larry, we shouldn't leave out the discussion of European monetary policy either, because this ECB meeting tonight, you believe, could wind up as being one of the most important events actually of the week. Tell us why.
I think so. I mean, I don't think that Trickett's going to be raising rates, although just most recently they raised the odds to 40% that they're going to. They're not going to raise rates, but you have to watch his tone. If there's anything in his language tomorrow morning in the U.S. that suggests that, that they will not be raising rates. You can see a huge short squeeze in the dollar, and it could just unwind this whole risk trade that we've been dealing with over the past couple months. So it's not something that most people have been talking about, but I'd look at it very closely. The Bank of England's on the other side of the story. Their inflation numbers have come out a little bit more lukewarm as of late, so there's really no chance of them raising rates. But the ECB, I would be really concerned to see what's going to happen tomorrow morning.
And that's because, as you said, it can affect the currency markets, and you believe that's really all important for equities right now? Is that where the main game is for you, Larry?
Yeah, I mean, as long as this disparity of the United States policy compared to the rest of the world exists, we're going to continue to see the stock markets rally, especially when you look at the earnings growth in the United States, in most of our equities. I mean, right now, if you look at our earnings growth, it's running at 14.5% over nominal GDP. What's holding us back from really recovering is our job situation. So all that to say, it's really important right now to see this disparity remain in place.
Hi Larry, Chris Stott here from the studio. Look, we touched on the ECB and what they're going to do with rates tomorrow, and they moved for the first time, as we know, last month. How aggressive do you think they'll be over the next sort of 12 to 18 months or over the medium term in terms of keeping a rein on the inflation over there?
You know, I think they really do want to raise rates in a bad way, and it looks like, I think July is the next time, and they'll probably give that signal that they will be raising rates, because the German and French numbers have all been very, very good, and just as of yesterday morning, they sealed a deal with Portugal with their debt situation. So it just seems logical that they will raise rates, but it'll become public knowledge sooner than later.